Kalimera Anthropos, Kalimera Nerandros, Kalimera everybody. Good morning, everyone. That's a quick update from me here at OIKONOMIKA, all about economics and finance. And I couldn't spare a minute of time after uploading my latest content that you can find on the channel. It's what is the title? Okay, stock market cyclicality, technical indicators, and stock market pullbacks. I just uploaded yesterday because I saw it coming well in advance. Also, thanks to all the work that I do in researching with models, volatility models, and stuff that it's not available to anyone on this platform like YouTube or anywhere that you can find. As you can see here on my screen, I'm sharing with you a forecast that I managed to put together of the European indices, but the forecast that you see is the cyclicality of the market, so it's extrapolated from the data that you can find from Yahoo Finance or other databases. So from the price action, from the closing price, then there is a whole model that transforms the price into a periodical function, and then it gives you the cyclicality of the stock market, the up cycles, the down cycles, the expansion, the bearish contractions, and all that kind of things. So, as said yesterday, I was expecting, as reasonable as it is, an equities market pulling back from the highs, which is pretty much natural. I said yesterday, okay, we got Halloween, now we get into the darker times, and so whenever something is dark and it's unknown to us, we want to take distance from that. We try to find some sort of protection, and that's a metaphorical Halloween metaphorical method to say that when we go into Q4 and into Q1, into the winter period, I think what we see in equities, mainly in equities, is that the asset allocation tends to rotate and to change, and also portfolio allocation tends to change, because probably there are many factors, which is among which there is window dressing. So those funds which have been underperforming, they try to find the last minute gain to basically match the benchmark that they have to achieve. And I was expecting, and I think that this drawdown will go on for a little bit, also into Q1. At least we are going to have equities or stock prices correction, pullback from the highs, at least going into the Christmas rally, when basically portfolio managers, they will try to find some so-called bargain. Although as I said in the video that I seriously invite you to watch, although it's not like a comedy joke or whatever, but I also said that it's important to be aware that the stock market structure has profoundly changed, because we have high frequency trading, we have a 0-day option trading, and those kinds of arbitrageurs that are in the market, they violate the efficiency theory hypothesis, so that the stock market, they are efficient, and wherever there is an arbitrage, the arbitrageurs comes in, exploit the arbitrage until the mismatch between the on the mismatch of price for the same financial asset, the gap it's closed, so the arbitrage doesn't exist anymore. But what do we know is that high frequency trading businesses like Citadel, they make of arbitrage their business model, because they exploit nanoseconds, microseconds difference in prices, and basically they racket in millions, if not billions of dollars. And so the whole market structure, it has not completely changed, but it has been altered, because now there are firms which happens to be also market makers, which are able to easily exploit arbitrage opportunities for any kind of stock. And I said yesterday that whenever we have high frequency volumes of transactions for any stock price, and we compound that with the 0-day trading expiration for option, the intraday option market, which is gathering more and more and more volumes from all sorts of angles of the market. They can be institutional investors, it can be hedge funds, it can be small retail investors, it can be the day trader that has found this new fancy thing, these new products, which is 0-day option trading, intraday option trading. And I explained things which are knowledgeable to anybody, that whenever you have a very high volume of derivatives trading on a stock, or even on indices, or stock futures, or treasury futures, there is the delta and the gamma factors that force the underwriter of the option to delta hedge what the client does. In other words, what that means, if I take 10 million naked puts on Tesla, what happens is that the market maker will be forced to short Tesla stock to delta hedge the potential downside into the stock. The same happens if I take 10 million naked calls, or call spreads, or any sorts of derivative trading strategy that expires the same day, okay, and I take a huge volume of calls. I buy a huge volume of calls for a certain stock, I don't know, any stock XYZ, right? What happens is that the market maker, or the firm that writes the call for me, okay, I buy the option call, there is a market maker that provides me that option. They are forced, for delta hedging, to buy the stock, because as a trader, I'm betting that the stock goes up. How do I do that? I use derivatives. And I have the delta and the gamma, which are the first and second derivatives of the price, of the volatility into the price. So the delta and the gamma effects, which happens for the same day on a certain stocks, it forces, it compels the market maker, which can be Citadel or can be an investment bank, also to buy that stock, simply because of hedging requirements, because they provide the option contract, but on the other side, at that point, they have to buy the stock. And this dynamic, they are not anymore for, I don't know, a 7 days time, a 14 days time, or a long-term option contract that I can use for hedging some portfolio risk. Like, for example, I have a portfolio of stocks, and I want to mitigate my downside risk, and I use a most known strategy which is called the marriage put. So basically I'm long stocks and I buy some put options on the stocks that I have so that I protect downside. No, that is an old style strategy, because what happens today is that because we have this new market, this new method of trading options which expire the same day, market makers, they are forced to delta hedge their books at the same moment. So that amplifies the upside or downside move for any stock price, index futures, treasuries, in a single day. So that's why what I'm saying, it's something that people in the industry know. Maybe the most common person, they are not really aware of how the digitalization of financial markets, it has provided new technologies, and the structure of market has changed, because now we have high frequency trading firms which exploit arbitrage, and the huge volume of transaction, it can move up or down the price of a certain financial security, but underneath there is no value, there is no substantive value in that price, which is it's practically sorry about my French, it's inflated, just only because for the sheer volume of transaction that you have. And if we couple with that the same day option trading that amplifies the upside and downside volatility because of the delta and the gamma and the delta hedging that the market maker has to implement in order to protect its own brokerage services, brokerage balance sheet or cash flows, then we see that the volatility, the intraday volatility in markets can be very, very high. And that basically becomes a huge, very large price moves. And when the price moves so wildly, then you see that the huge price moves, it does not reflect what is the investor or the portfolio manager balance sheet or fundamental evaluation of the company based on the income statement, on the cash flow statement, or the latest earnings call. So there is this huge discrepancy between what can happen with very large volatility, which is caused by high frequency volume of transactions, so the high frequency trading firms, which are market makers and which are basically algorithms that react every millisecond to anything that happens into the market, and they want to exploit arbitrage. They buy at a lower price and they sell the same financial security at a marginally higher price. They pocket in few cents, and they bring, by repeating this transaction at light speed, at very high volumes, hundreds of millions or billions of dollars, they bring in a riskless profit, because it's by definition an arbitrage, it's a riskless profit. Okay, if I know that Amazon it's $210.10 on Paris Stock Exchange, and the same Amazon share it's $210.12 on Frankfurt, I buy Amazon stock in Paris and I sell it on Frankfurt for 2 cents spread. And that's what high frequency trading firms do. But this kind of mismatch, discrepancy in prices for the same financial securities, it happens in seconds. So those firms, not only they have to be fast, but super, super fast. So it's something that only very few financial firms nowadays do in markets. Not even investment banks, I don't think they are able to do that. And for what I saw on GitHub for the Goldman Sachs open repository of their models, Apache models, I would not. I still have to read the code and something like that, but it seems to me they are pretty basic. Like Goldman Sachs, they work with rolling volatility, and that's it. They measure the standard deviation, and then I don't know what they do. I'm fancying about other stuff. So we have the market. It's very different from what the normal person presumes to know it is, because digital financialization of markets has created arbitrageurs, which work on the principle of exploiting very short period where there is a mismatch in price for the same financial asset. And we have intraday option markets, which amplify the upside and downside moves for any stock. Now, the video that I did yesterday, bear with me because it may slow down the connection, but bear with me because it's what I'm saying. It's actually very real and it's visible. You can see it here. It's also in my other video. What happened with Meta is this huge gap that you can see here. There is a huge gap, which is $100 gap in value for the same financial security. How this happened? And basically, you see that I don't know. There is the earnings call, so in the after hours the stock goes up or down, and in the following day then you have the retail investor reaction to the earning call, and you have more selling into the pre-market, and then there's this huge gap in value that it's created for in a Meta stock, okay, Meta Facebook, okay, Meta AI platform, okay. So here there is $100 gap, okay. And how come that Meta was pushed to $800, and then suddenly you have this vacuum here, which is humongous? So this happens because the market structure, as I've been blabbering, as I've been saying for the past I don't know for how long, the market structure is profoundly different from what ordinary investors are aware of. There are arbitrageurs, there is high frequency trading, which exploit these and the mismatch in price, and what they do, they are able to push up the price, but because they go in and out, they buy and sell the same share for a fraction, and they pocket a small profit. But when they go out of the share price, they go out at a marginally higher price. But that what happens, there are other people in the market. There is the retail investors who goes and buy the shares, buy the same stock. So that produces more and more bidding on the same price, and the price goes up and up and up. So not in a sense, the mechanical functioning of this thing, it's what is called pump and dump. Okay, now I don't want to say that high frequency trading businesses, they do pump and dump. I'm not for a minute suggesting that. Those are market makers who provide liquidity. But the sheer volume of transactions that go in, they can produce air pocket of value or price which do not reflect the value of the company. And so the stock price is pumped up a lot just because of volumes of transactions. And as I said, with the intraday option market, the delta and the gamma effect on the stock price and the hedging that is required, it forced market makers, hedge funds, to go long or short a stock, even if it does not, the price, it does not reflect the intrinsic value of the company. Okay, so we are here, and we see that Meta, the stock price still goes down because the real value of the company is not $800 a share. Because if you go and check what is the P ratio or the multiples applied on the stock for the revenue and the net profit that they bring in, it's really excessive compared to what is the company value. Now it's Meta because but so many financial securities, they have this huge gap in price, and that is the business of the SEC to, they know it very well, that the sheer volume, the speed light volume of transaction, it can push up the price, and it can pull also other sorts of players which are into the market into buying or selling a stock, regardless of what is the idiosyncratic value of the company. Just for looking at the price and the volume that goes into that moment. Okay, so there is this great distortion in markets, and I cannot do anything about that. As I just said, it's for regulators to understand whether there is scope for making sure that high frequency trading and intraday option markets, they don't exploit arbitrage opportunities, or they don't create a distortion of stock price which deviates too much from what is the real value of any financial security, because then all sorts of theories which underpin the functioning of markets, they are violated, because markets, they are not efficient anymore if we allow that there are arbitrageurs which can exploit price arbitrage, and those price arbitrage are never closed, are always there. So the market is not efficient anymore. And there are people which, by means of better technology and direct connection to stock exchanges, they have a material riskless advantage and profit that they can make compared to millions and billions of people around the world. So I cannot put it clearer than that. Okay, now if somebody has on a 401k Meta platform finds a gap of $100, then I would be a lot not upset, but I would find difficult to understand, and what you will be fed is that, okay, it's after hours or it's pre-market investors doing this, that, and the other. But a retail investor who has a 401k and has this kind of price gap, it has to stomach a lot of risk, and so I don't know if it's fair towards people who are forced to invest into 401ks and they are forced to buy stocks. That's very simple. So after having said that it's important that anybody who approaches financial markets and opens a chart on TradingView and see these things, this price gap and something like that, it's important to know that the market structure is not what you are told it is, but there are market makers, there are arbitrageurs. The market as it is right now, that's my personal statement, which is not a dogma, it's not efficient in the sense that there are market makers who can take home a riskless profit compared to the vast trading public, retail investors or savers or pension funds who manage pool of money for wannabe pensioners in the future, which they want to be rich on paper with stock prices and stuff like that. So going back to what was the yesterday work, I uploaded the content and I said, okay, I'm expecting a correction which will go through Q4 and Q1. The market will find a bottom or a trough in the cyclicality of things, the seasonality of things, and then between February, March or April of the next year, by transitioning, going from Q1 and Q2 of 2026, we will have the opportunity of allocating towards stocks which have pulled back, or we see that the price has been discounted for many other variables. Now, what are the factors that we have to consider today? It's one thing which is my personal assumption, and again, by no means it's a dogma. Do your own research and always ask to your investment banker, go to the bank, whatever is the CFA, personal advisor. Do your own research. Ask always to people who have business credential to provide financial advice. What I'm sharing with you is only my own research, which I do because I study a degree in a Bachelor of Science in Finance, but I don't have any authorization to do this or that or the other. But I'm showing you what is my research for educational purposes, and then you can confront it with whoever you want to confront it to. So what do we know is that when stocks go down, you have a defensive move like capital inflows. They may go towards the currency. And I presume that what US investors, or not investors, but the positioning of investment banks or hedge funds, especially from what concerns the US market, if they have to take a drawdown in stocks, they will probably try to throw the dollar wreck ball to the market. So what I'm saying is that I do expect to see a bid on the US dollar, also because of mechanical interest rate differential. So the carry trade is that you borrow in yen and then you park the money in dollars, which is a higher yielding currency, or in euros or in pound. But if equities will have a drawdown, I think that drawdown goes into the dollar. And I cannot say any more than that, because I don't know how are, not that I don't know, but I'm not sure of what can be the flows on in the treasuries and that sort of stuff. Also because there is a government shutdown, so the possibility of achieving a balanced budget for the US, the Treasury Department is a whole other ball game, of which I don't have a crystal ball. So to make things easier, I believe that the outflows from stocks will go into the dollar. And what that will bring is probably a lower euro and a lower pound. And why? Because we will have also the Bank of England interest rate monetary policy meeting, there is a chance that the Bank of England will try to do another interest rate cut, because the economy it's slowing down, so they would try to help the exchequer in order to bring down the yield curve. So, but even if the Bank of England decides to stay where it is, but I believe they will do a cut because they follow the Federal Reserve. The Federal Reserve has done a decrease of 25 basis points, so the Bank of England eventually will follow. Although the inflation environment in the UK is higher than the United States, so the Bank of England is in a very difficult position. It's not enviable to anybody in that instance. But what it happens is that there is also every end of after Halloween, we have the fiscal budget, the fiscal position announced for each government. France, I don't know if they have a budget. Germany, Spain, Italy, and the UK, they have a budget. They will announce it on the 26th of November, which is 3 days after my birthday. I'm honored at that, which is very close to my birthday, and I hope it goes well. But because the exchequer, it stands to do two things: to require higher taxes from wealthy people. If I am any wealthy person, what does it say? Okay, I'm gonna sell everything now before taxes kicks in for higher capital gains, and I pocket this stuff, and then I will find out how to manage the tax bill later on. So there are two things: capital gain tax going in. What happens is that investor behavior, I'm gonna sell everything, not everything, but I'm gonna diminish a lot my stock portfolio now if I can, and take profit, go to cash, in order to manage at a later stage the theoretical or the feasible capital gain tax that is coming down the pipe with within the UK framework. Second, because the exchequer will need to finance the budget to close the funding gap within the fiscal position, they will want to issue more debt. And even if the Bank of England goes towards them and they try to help them and say, okay, we will manage quantitative tightening, but crucially, we will do another interest rate cut to try to bring down the cost of debt, the only escape valve for that to happen is for the currency to depreciate. These are textbook mechanics in fiscal policy and monetary policy. Whenever you are issuing more debt, it's almost sure that the value of your currency will go down, because it will have to absorb issuance of debt that you are doing to finance your fiscal position. That happens everywhere. And it's clear to see as the sun. If we see at Japan, they are at 270, 280 debt to GDP, and the Japanese yen loses and loses and depreciates and depreciates and depreciates. So the higher is the debt, the fiscal position requirements, whenever you're going to borrow more or to roll over some debt, then the only escape valve is the currency. These are mechanical things of fiscal policy. So if the dollar wrecking ball, okay, like you have this huge caterpillar and they have those demolition machine with that huge huge metallic sphere, and then they wreck the whole thing. So if the dollar wrecking ball goes straight at the currency, at the FX market, and there is a fiscal position requirements for the pound, and there is a lower yielding euro, and also the Australian dollar, they are in a very difficult spot, then I believe that the pound will go down, will have to depreciate, mechanically depreciate more from where it is now. I cannot quantify where the pound will go, but if we just look at the chart, okay, there were some drawings that I've done previously in my life somewhere. So if only we look at the chart, we see where sterling is going somewhere. Now, I'm not a fan of technical analysis because I'm not a believer of technical analysis for all sorts of other reasons, okay? Although it's very, very useful, and technical analysis is part of the efficient theory hypothesis of market, that is the weak, the semi-strong, and the strong market environments. But anyway, we can see that the pound has been depreciating. It's not starting today, but we are probably going towards the end, the last push. Not the last push, but it's the last boost in pound depreciation. Why? Because there is the fiscal position that needs capital inflow, and then the most natural thing is that the currency adjusts faster than interest rates. And lowering interest rate will produce the boost to the downside. So I do expect the Bank of England meeting to be a live meeting, and I don't know if I see a sterling sell-off. I just put together a couple of factors, and I will not be surprised. And then we will take it from there. I don't mind the pound going up or down. We are 130. It means that the pound, it has a 30% premium on the dollar, and we are talking about a 3 trillion economy compared to a 36 trillion dollar. 3 trillion pound compared to a 36 trillion dollar economy, and still we are giving away a 30% premium to sterling. No problem, take it. You can take also 50% premium, I don't mind. You're very welcome. But if I see the currency depreciating, it's simply because there is a need of inflow from other parts of the world, and so the currency exchange, it needs to soften to become less expensive in order to attract capital inflows and have investors buying, not only domestic like UK banks or UK pension funds bidding for gilts, but also foreign investors, okay, to have a healthy sovereign debt market. So, dollar wrecking ball, the Bank of England, which will probably do another cut, probably. I don't know. We will see if they can find any reason to cut interest rate. They will tell us what is. They will do the press meeting. They will tell us clearly what is their rationale, what is their macroeconomic analysis, and they will tell us, okay, we decided to hold the interest rate, or we decided to do a 25 basis point cut. But tendentially, all central banks, they do follow the Federal Reserve. So because Powell is very, very funny. Powell did not, okay, let's finish this sentence. Because the Fed has cut, I believe that the Bank of England will cut. Then, Powell is very, very funny because he said, okay, we don't ask for trouble, but. Powell is not asking for trouble, but. It said something very, very clear and interesting. So they say they're going to taper off the pace of quantitative tightening because they believe that at the point where the balance sheet is, it's the size or the liquidity requirements that basically makes function the plumbing of the market. So all the bank reserves and all the clearing for the repo market and the overnight liquidity that it's needed to make the dollar funding market work. But they said, okay, we're gonna taper the quantitative tightening. They will use the existing flows of maturing debt. They will reinvest. They will do a sort of immunization. So they will reinvest the coupons into other treasuries, but in order to bring the modified duration of the portfolio aligned to what they want to be, like 7 year, 8 year, 10 year, I don't know. They will have specified what is their idea of overall duration for modified duration of the whole treasury holding that they have. But Powell said another thing. Powell said that our other non-balance sheet, other liabilities will grow. Which are other liabilities? Which are currency in circulation will grow. So what Powell said is, okay, we are tapering QT, we are not going to expand the balance sheet, we will reinvest the proceeds of coupons into treasuries because we want to align the modified duration of all the stock of treasury that we have to a certain horizon, a certain duration of the whole portfolio. But bear in mind, currency in circulation ends the AKA, or in other words, money supply, which is another liability. Currency in circulation, it's another liability of the Federal Reserve, will continue to grow. So Powell is not asking for trouble, but he told us that currency in circulation or money supply will continue to grow. And so that means, oh dear, that inflation will kick in again. There are no saints nor Jesus Christ that will spare us for higher inflation. Because whenever the money supply doesn't stop, inflation doesn't stop. Right? There is no way it won't stop. So even if they said, okay, we're gonna adjust this, that, and the other, we're gonna adjust the modified duration of our treasury holdings, because they have also mortgage-backed securities, they have all sorts of things on balance sheets, and they will taper quantitative tightening, but the other liabilities as currency circulation will grow. And so I do expect next year we will need to see what is the pace of money supply, and because also there is a huge component of private credit creation for what is the dollar funding market, and there will be inflation. There is no way, especially in particular if tariffs will stay where they are, or they will go up or down. We don't know what is the volatility of the onion brain of the White House people. So I'm sure that will be very, very, very funny. It will be very funny indeed. It will be very fun indeed. But if we have the dollar wrecking ball at the market, and the Exchequer needs to fund more borrowing, and the Bank of England cut rates, the pound will go down a little bit more. And it will adjust where the FX market basically will find the point where, okay, we have a bottom, but it's here in the RSI, okay, when the, not for technical analysis, but the RSI is here for technical indicators. When the RSI will be down there, maybe, I don't know, we will break below 130, I don't know where it will go, but I do expect reasonably to see more depreciation in the pound toward this direction. I cannot give you an exchange rate because it changes by any second. Okay, I cannot give a number. I'm not here to giving lotto numbers on the what is our superstar, that stuff like that. But I'm sure the pound will go down, as all other currencies, is the euro and also the Australian dollar. This is very, very funny, because what happens is that the Reserve Bank of Australia, they decided to cut interest rate. They followed up into the interest rate normalization cycle, okay, with other central banks. But I think they are in a bit of a predicament now, because also the Australian dollar, if the US dollar starts really the wrecking ball, is gonna have a lot of volatility, and I think the market is gonna play a trick to the potentially the Reserve Bank of Australia. They are going to be challenged in FX market. Because why? Because why? Yes, that on the other. Because the headline rate of inflation in the Australian economy has increased, and it's basically matching what is the Reserve Bank bank rate. So we are around 3.5% inflation, 3.5% bank rate for the Australian dollar. And that's a very tricky spot where to be, because they could be if inflation expectation, they are already at 4.6%. So I want to take this I want to see the indicators of Australia, the Australian indicators. Okay, bear with me. This is all live, and thanks for watching. I hope you find it interesting, and we will see now why the Reserve Bank of Australia is in a very tricky situation. Monthly CPI indicator 3.5%. Inflation rate year on year 3.2%. Okay, here is projected to rise a little bit. Also, inflation expectation in Australia, they have deviated above, way above 4%. And the bank rate it's at 3.5 or something. Okay. So, okay. Trend mean. Bear with me, I want to find these things because it's very, very important. Okay, let's do countries. Australia, I think that here we will have the broader thing. Okay, so inflation is at 3.2%. Interest rates, the bank rate is at 3.6%. Inflation expectation that we can see here, they must be okay. Inflation expectation, they are at 4.8%. So there are Australian consumers monthly CPI indicator 3.5%, services inflation 3.5%, rent inflation 3.8%. So these inflation figures, they are bang on the money for where it is now the Reserve Bank of Australia, sorry about that, bank rate, which is 3.6%. But going back to what Powell said, he said, okay, currency in circulation will continue to grow. The latest data in Australia, they showed us that loan growth, it was 7.3% in September. So there is a huge money supply coming down the pipe of Australia inflation. Australian consumer demand and inflation expectation, they are 4.6%. So the Bank of Australia is at 3.6%, and they are in a very tricky situation, because if they start to see that the market is going to depreciate the Australian dollar as a signal, or okay, are you controlling inflation, hence the value of your currency, or we have to wreck everything and short the Australian dollar and force you into hiking interest rate. So these are tricky things that happen every now and then when central banks, they see that when basically macroeconomic data, they go against what is the position of the central banks in terms of interest rate, and when money supply it's continuing plentifully, 7.3% loan growth. Okay, take as many Aussie dollars as you want, but then don't go to the supermarket and complain that a pint of milk it's 5 or 6 Australian dollars. If you keep pushing this private credit money supply, then eventually inflation expectation are 4.6%, then prices will continue to go up, and then the Reserve Bank of Australia will be offside. And then what happens to the currency? Okay, the more currency we issue, the less is the value of the currency, or the purchasing power of the currency. And if we have capital flows that go out of stocks and go into the dollar, then the whole other G10 currencies, they will take a hit. They will see depreciation. That's how the natural trading in FX market works. That's what FX traders in investment banks or hedge funds, what they will do. They will short everything. They will short the euro, the pound, the Australian dollar, the Canadian dollar, the Mexican dollar, everything, and they will pile everything. They will go long the US dollar. That's what will happen. And it's not going to be like that for 10 years. It's something, it's a flow that can happen during a stock market sell-off. Okay, money goes out of stocks and goes into another yielding asset, which is the currency. Okay, and that makes selling short the Australian dollar or the pound or the euro a easier trade to do. So that's what I do expect to see, and I'm not expecting anything out of the ordinary, because these things, they happen every now and then. They are they are usual things that happen all the time. But from a macro perspective or a monetary policy perspective, if inflation starts to creep up again in Australia, then I want to see what they're going to do. Because they are at 3.6% and they are cutting interest rate. And you know, now central bankers, they use this very clever statement where they say, okay, our monetary policy is not on a predetermined direction or path. So they say we are cutting interest rate, but we are not saying that we are on a path, continuous cutting cycle of interest rate, because they know that they are in a very dodgy situation and that inflation is not under control. Prices are not under control in under any macroeconomic scenario and fiscal policy scenario. And because they know that we are in a debt Ponzi scheme, whenever you stop printing money, everybody goes insolvent, then they know that money supply is to continue in some form or another, because there are debt coming up to service any minute for anybody in the world. And so when money supply is forced to be thrown into the economy, then you'll see that inflation will stay higher. There is no other way. The only method to escape, to remedy to the catch-22 of debt, inflation, and money supply and inflation into the economy, is to have debt deflation, which is a financial crisis, or is an economic crisis. So when you have debt deflation, it means that you start to mark the price of the assets for what is the real value, and now you mark up the asset, and then you build this asset bubble and stuff like that. That's where we are. Okay, so going to the stock market cycle, again, to the cyclicality of markets, my models tells me that in the short term, the DAX, for example, let's see if I can show you this thing without making too much disasters. Okay. The DAX will have a trough in a bottom in January 2026. So the sell-off which has started now, my model tells me, okay, the bottom of this correction will be in January. Even if there are rallies, even now and between the few months period, then the bottom will be in January. So at the end of January, probably January will start with I don't know, it can start with huge market sell-off, and then we will have a peak in March and then another trough in May. But if I go on this other one, it has a very longer cycle with less in between periods. Sorry, my tongue is sticking everywhere. The trough for the DAX will be here September 2026. So here, what we have here, we have a cyclicality which is the amplitude of this curve, it's a bit larger, so it means that the frequency of the peak and the trough, the up and downs, is less frequency. We have less curves, okay? We have less frequency. What that means to me is that probably we will have a market drawing down even down to September, like a bear market down to September. I don't know. I mean, that's what I can extrapolate from the model, which is not really precise, but these are all tools that I try to gather in order to, first of all, to experiment with calculus concept and to have so many different angles to understand the behavior in stock market, which at the end of the day, it's made by people, by investors. So it's made by human beings. So the DAX correction will find the bottom in January, but even if we have a peak in March, it's, let's call it a bear rally, because we will have another bottom in May. So I think we will have more choppiness in the next quarters, especially because stock prices, they are very, very high, and the risk is very, very high in have stocks at these prices vis-a-vis what is the real economy. Germany is not a booming economy. So if you have these stocks, the stock market is sky high, but the economy is completely the other way around, I do expect that then even institutional investors, investment bank, they'll have to say, okay, probably we pushed it too far on the upside, and then we will have this sort of choppiness. Like the market bottoms, you have a sort of, call it bear rally, and then you have another bottom, and then you have another rally. A lot more volatility of moving up and down before then, I don't know, you can find a trend. Okay, the same is for the French market. Here, even the trough in the market will be in May 2026, and then there will be all choppiness throughout 2026, and we will have a new high in November 2027. These are very sort of not long term, but they go far in the future, which we have to take it with a large pinch of salt, because it's impossible to forecast with exact precision what's going to happen in the future. We don't know what's going to happen tomorrow, but we try to put together tools to have the best outcome. And so we can see how the VIX, the volatility index, it behaves the opposite way. It tells us that the VIX curve will peak in March 2026. So it's reasonable that we can expect higher volatility from now into the end of Q1 2026. These are 5 months of market activity, and if you are an investment bank, you will have to start to hedge your bet and go and be long VIX futures and do all sorts of hedging whenever volatility goes up. Okay, so there are all sorts of dynamics which I do not know everything, because I'm here live on YouTube and I'm not in a trading desk working for an investment bank. But for sure, there are all sorts of volatility hedging, the rolling yield of the futures contract. So whenever the rolling yield becomes negative, I mean the spread between the VIX future and the futures contract becomes negative, then the investment bank is forced to hedge, and they have to buy more volatility, so to be long more volatility instead of being short volatility, and that compiles up the VIX index, and it can bring it from, I don't know, from 18 to 20, and if my rolling futures, the yield becomes negative, I have to buy more VIX futures, 3 months, 6 months, and then you see that volatility spikes higher. But the cyclicality of vol tells me, okay, for 2026 we will have a peak in March. So if I'm trading, I can buy volatility now, and I can hope, fingers crossed, that I make a profit being long for 2, 3, or 4 months. Okay, although there are big futures that expire, so it depends on how you do that. And then you see there is the model. It says, okay, you have a trough in July, and then you have another peak in February 2027, which is very, very consistent with the simple fact that we know that Q1 in markets, they are treacherous. There are sell-offs of all kinds for all reasons, and it's reasonable to have predetermined hedging for being long vol in the first 2, 3, or 4 months of the year. And then you can short vol as a systematic strategy for the rest of the year, okay? But we can see that the trough will be in November 2027 for vol, which is very consistent with the forecast that we have for example, here, if we take the CAC, the French index, okay, it tells us, okay, the market is gonna peak again in 2027, November 2027. It's gonna reach a new high. And that corresponds to the opposite, to the new low that will be for volatility. So they match together. So that comforts me and say, okay, it's not really pie in the sky, but there is some there is some calculus behind the modeling of the forecast. But you know, we cannot be sure of what happens. Now the IBEX, the Spanish equities, will see a bottom in May 2026. So probably Spanish equities will be more volatile than stocks which are listed in the German market. So that makes a different balancing approach. You can allocate first to German stocks rather than Spanish stocks. These are all conjectures for portfolio managers. The FTSE, here also we have another huge peak rally in November 2027. So it's the same synchronized frequency of up-down peaks and troughs in the market. So it's the same cyclicality across the European indices, which is very interesting. It's really fascinating. And here we have a trough in February 2026. So even for the British stocks, for the United Serfdom equity market, there will be a correction which will end between February and March. So going into March, probably you could start to allocate and find what are the bargains in the FTSE 100 or the FTSE 250. But bear in mind, if there are higher capital gains tax, I don't know how that variable can then change the whole investor behavior. But there is the cyclicality, and then you see that there are other troughs in November and April 2027. So all the rallies that we will see will be some sort of bear rally, okay, recovering some previous levels. But the new high will be so far into the future, 2 years time, November 2027. See how far I'm projecting for you that you are watching what is going to do the market. And please remember this. I will try to put the charts on my channel. Follow, subscribe, because I will update from time to time how my model really corresponds to the benchmark, to what happens into the real world. So that's the fascinating part. We are modeling, we are creating a concept, we create a model, and then we want to see if the model works in the real world. That's how science works, okay? We create an hypothesis, we create a model, which can be an algorithm, a machine, any invention, and then we test it. If our experiment produces a result which is empirically feasible and generates an improvement, then that experiment has some validity, and we can utilize the same method in every corner of the world. You can be sure it will produce the same result. That's what is the beauty of science, because science is precise, okay? It's not many words that I'm saying now. So follow the channel, because I will update how my models are faring with what happens into the market. And then you can comment and say, okay, your models are crap. I don't mind. Say, you can suggest how better I can do. You are very welcome. Same again, stocks 50, a bottom in May, and we will have choppiness. And again, another peak in the market will be in November 2027, and then some sort of big correction in November 2028. We will talk about that later. So BFX is the Belgian equities market. So all in all, seeing the market action today, I do expect this rolling correction to go through November, December, January, February, the end of Q1 next year. And it depends from which market. Here, for example, the Netherlands, the AEX benchmark index, it has a first bottom in January, but then it has another bottom in May. So you have in between a short rally, but then you have another correction again. And you see here, detailed view, you see more how choppy should be the cyclicality of the equities market for the Amsterdam exchange index. Okay, so yeah, what we have, this is the Swiss market, also correction down to May. Okay, the Japanese market, again, you have a bottom in January, a small rally, and then another bottom in May. So also a rolling correction for Japanese equities, which will be huge, because Japanese equities, they only know one direction, which is going up. And it will be a breaking news if we will have the Japanese equities market, the stock market, going down for some sort of correction because prices are too high. Oh wow, it cannot be. So what is the main concept or the takeaway that we have is that if we are going to see this rolling correction from November, December, even if we have a short-term Christmas rally and then we have a Q1 correction and we have some choppiness in between, like a bear rally and then another sell-off until all the dust settles between April and May, or the second quarter of next year, then we know that also volatility will be higher and the VIX will probably peak in February, March 2026. But we have other two variables that I'm throwing to you, and it's the dollar wrecking ball. So probably we will have stronger US dollar, and the Federal Reserve will not cut interest rate in December, I'm pretty sure. But probably we will see a FX market moving, with the euro going down, the pound going down, the Australian dollar going down. I will follow through with what does the Reserve Bank of Australia, because they are truly in a very tricky situation. If inflation and anchors and inflation expectation, they are already 4.6%. So it's 1% higher than the Reserve Bank of Australia bank rate of 3.6%. So if inflation starts to go up again, because we see the money supply continues unabated, then next year it will be very, very funny. And I can presume that all the choppiness in the stock market that I can extrapolate from my modeling will also be caused by higher inflation. Because don't forget, Jerome Powell is not asking for trouble, but because other liabilities such as currency circulation will continue to grow, I expect higher inflation next year. And so for every higher inflation print in the market, there will be a stock market scare because the Fed will be offside and they will have to hike to revert back the hiking. They cannot cut. There will be all sorts of volatility. So I do expect 2026 to be really, really funny and a lot of choppiness. So subscribe to the channel, and if you can, leave a like or a comment. And thanks a lot for following me today, and I'll see you soon. Enjoy the day.